What up with the wheelhouse, baby? You guys ready to hit it? You ready to get it? You ready to level up and get with it? Well, it's time to charge those batteries and get the money printer out because we are headed to the moon to stack some chips and get paid out. Now, on this channel, no baby stepping, no line stepping, no loose talk, no second thoughts, and definitely no maybes. And like I always say, green lights to the beach, baby. Now, if it's your first time on this channel, go ahead and hit the subscribe, hit the like on the video, and select all with the little bell so that you get the content. And check this out. I got a little moon man on my shirt because we're about to stack some chips and go to the moon. So look, this might be a long video. I'm going to put timestamps in it. I thought I would kind of give you a little mental taco and hook you up with some tips that help you for investing and trading, whether it's crypto or stocks. And I'm going to give you 8 really good tips, like really good tips. And this is just a little tasty nugget of some of the topics that I go through in the courses, and the Discord link is in the description below. You could click that, you could get in, you can upgrade, get my alerts, you could do all the courses, you can have the one-on-one sessions with me so I can go answer any questions that you may have, or do personal mentoring or personal training on a topic that you're interested in. Those are going really well. I've been doing about 2 a day, and definitely been staying busy with that. And every single one, I've enjoyed the conversation, and everyone has been a little bit different and unique, but they've all been really good. So really enjoying that, and I'm very grateful. I'm also very grateful just for you guys, for the comments and the support on the channel and the Discord, and everybody helping out, the moderators, the server managers, just everybody, and everybody in there doing charts and engaging and helping out, and it's a real cool vibe. So I really appreciate that. So what I wanted to do was go through 8 different things that have to be ingrained in your brain. All right. And if you get, there's many more, okay, but if you get these 8 kind of ingrained in your brain, then you're on the right track. Let's put it that way, okay. So the first one I want to talk about is trading with the trend. Now, I'm sure you guys feel like I'm probably beating a dead horse. I've talked about this, at least 3 times, but it's just so important. Sorry, I'm just putting my AirPods in here to charge for later. Trading with the trend is super important. So, a good way to do that is by using the moving averages or the EMAs, the exponential moving averages. I prefer the exponential moving averages because the last 10 days, it really weights it, and it'll start to curve up or down depending on, basically the last 10 days or so. So I use the EMAs myself, but here's a little tip. If you want to use the moving averages, those are wonderful for supports, and they're best used on the bigger moving averages, such as like the 300, the 200, the 100, and the 50. But I choose to just do all of them on the EMA, and I have a reason for that because everything that I do is momentum based. That's why I use Hike and Ashi. It's a momentum based candle. That's why I use the vortex, and that's why I use different indicators, because everything that I do is momentum based, because I am a pivot to pivot momentum based swing trader. I also know day trading very well. I also know investing very well. I have all kinds of techniques and all kinds of tactics for all different kinds of styles. And, I use all that information, intel, and knowledge to my benefit to make decisions. That's why not everything is just cookie cutter and robotic. Like, for instance, I say don't buy under the 200. Well, yeah, I don't want to put it on YouTube for beginners to buy under the 200. But I might buy under the 200 because I know how to spot momentum in a pivot. but that's a little bit more advanced. And that's something that once you go through the courses, you can learn to pick up that extra little bit, but it's much safer to accumulate above the 200. So any chart, whether it's crypto or stocks, has this very important line, this purple line, and that's the 200 EMA. Now, when you're above it, it's bullish. Okay, that means that you're going long. Okay, you're trying to make money thinking that the stock or crypto is going to go up. If it is below the 200, your mindset is thinking to go short, that you're going to be making money betting that it's going to go down. Okay, typically that's how that works. Now, the 200 EMA is the line in the sand, so above bullish, below bearish, and then it shows the direction of the trend. So this is trending up. Okay, that's a very good indicator. And excuse me, if you're buying to go up in an uptrend, you want to make sure that your 200 is also trending up. And you also can do that with the 50, the 30, the 20, the 9. I mean, all the moving averages and EMAs, show trend. Okay, so when you trade with the trend, you're not fighting the system. You're not fighting the tide. Okay, you can do it. You can pick stocks that are that will go up against the tide when the overall macros are coming down, but it's not recommended, and it is highly dangerous and adds a major level of risk. So it's always best to, when you want to buy something, the first thing you look at is it above the 200? That's called a condition. Okay, that should be your first condition. If it's above the 200, then that's good. Okay, now you can look at any chart. So let's just go look at this is Asana, so you can see it's in an uptrend. We can go look at let's just go look at Facebook. It's had some problems lately, but you can see the last time that it dipped down, the accumulation phase goes right over this base right here where the 200 is, and then people accumulate, and then this is called the participation phase, and that's the phase out of the 4 phases where retail comes in with institutions. And then there will be something that'll happen eventually in the 3rd phase of the 4 phases, which is the distribution phase. And it usually will show up in the macros will go down, and then the individual stocks will go down as well. And some will go down more than others, and that depends on, it depends on quite a few things. So it depends on the sector that it's in. If it's a favored sector, it might not drop as much. It depends on the cap. If it's a big company like an Apple or Microsoft, it probably isn't going to drop as much as some of the crazy high growth or like the speculative stuff is going to get hit first, but then like the Microsofts will be hit last. As an example, last February of 2021 through May, there was a big drawdown. There's a big overall market sell-off, and Microsoft only dropped, I think, 4%. Well, some of these dropped 50, 60%, in the high growth. So that's what I'm talking about. Sometimes the large cap with a lot of stability, that has good earnings, a lot of institutional support, these things won't drop as much, but they still will go through their thing like Facebook did. Facebook came below the 200, and then right when it came above the 200, it signifies, that you're back in an uptrend. And typically, as long as you're above the 200, it's safe, but it's even safer when you have, let me see if I can just draw this real quick for you. It's even safer when you break this particular area right here. So this base, so your first condition is be above the 200, and usually your second is to be right above that line, and we're approaching that line right now. And the reason technically that Facebook just went up when I'm recording this video is because it got above the 50, and the 50 is where large institutions, pension funds, insurance funds, they like to accumulate being above the 200 and then going through the 50, because it adds multiple layers. You have layer 1 is the 50, that's a support. You have the 30, you have the 20, the 9, and the 200. You have multiple layers now protecting your investment. Okay, so it's showing strength going up through the 50. and it'll show a lot of strength once it breaks past here, and then there will be a lot of accumulation, and it should go back through this whole scenario all over again. And that's the hope, right? So comes down. Last time it came down, it went all the way above. And so here's something that I wasn't going to put in here, but I'll just say. So when a stock is 100% in price above the 200, it is what's called overextended. And almost every single time, if it gets around the 100, we've seen it higher, even to 150. Tesla one time got to 125. But typically, like 100% above the 200, it's overextended and it's going to fall. And here's another tip: if it's about 7% above the 50, there's usually going to be at least a couple down days to kind of let it breathe and give breath in the market. So those are a couple percentages for retracement to keep an eye on when you're trading with the trend. And again, you can do this on crypto as well. So let me just, I know I'm in Webull, but let's just go look at a crypto. Let's go just grab Bitcoin as an example, or here, Ethereum is fine too. So again, trading with the trend. This is Ethereum. Okay, you're above the 200. So you don't really need to like over worry and over freak out. As long as the 200 is going up, you're in an uptrend. You're trading with the trend. So, if this thing starts to fall through the 9, it's a warning shot. It goes through the 20, it's a warning shot. It goes through the 30, definitely a warning shot. The 50, warning shot. But the 200, you got to get out, So you want to trade with the trend, whether it's crypto or stocks, okay? And that is just like the number one rule, all right? Now, let's go take a look at the second thing that I wanted to talk about, and you can do this the exact same way. So first, you're trading with the trend, and second, you are looking to enter technically. Now, there's a lot of ways to enter technically, okay? The first way, the old school way, I don't know why I can't think of his name. The guy that taught Warren Buffett, Benjamin Graham, is it? Yeah, Benjamin Graham. The value PE investor. So he teaches, and this is just an old adage, and it works, and it still works to this day. And basically, when you come up right above the 200, you almost always will have a long run because of the 4 market phases. 4 market phases are accumulation, participation, distribution, and then the negative participation where it drops, and then it kind of flattens out to the levels the EMA starts to accumulate, and then there'll always be this area right here. And on this chart, it would look like this, and it's on every chart. So it would be this peak, it would be all the way across. And your condition 1 is to wait for it to get above the 200. Your condition 2 is to wait for it to get out of the base, and then you accumulate, and then you go on this long, long run. And, it can go on for a long time, just like this thing has been in a bear for a long, long time. And so I can tell you right now, if I can get a chart to work properly. So here's an example. Okay, let me just stop it. Here's an example. Accumulation, participation, distribution, under bear market. It'll teeter up and down through the bear market, so you got to be careful. Major run, but a fake out again. Another fake out, still in the bear market. And then a crossover to accumulation, and there's your little wobble down, and there's your base above the 200 and off to the races. Okay, and then it'll just repeat. It always does. It goes up, and then it'll make this channel. See, I have the 2 lines. That's the distribution area. That's basically when Wall Street comes in and they say, we're going to start dumping shares, but we can't dump, $10 billion in shares or whatever the number is. all at once. So what we're going to do is we're going to come in here, we're going to get off a lot of them, and we're going to create this little mini correction. And then we're going to let it breathe for a few days, and everybody's going to be like, oh, okay, I've been through that before. It was just a really bad couple days. And then it'll kind of do this, and then they'll dump a whole bunch more. And then it'll kind of do this, and we'll dump a whole bunch more. It'll go under the 200, and it'll come back. And everybody will kind of be like, okay, it's going, it's getting okay. But, if you can spot this, right here that this is already creating a downward pattern. Okay, so it's got distribution going on in this channel, and that's something to watch out for, because right after distribution you're going to have that new wobble, the fake out, and then back to another bear. Okay, and then it's going to repeat. You're going to go through the bear, you're going to go through the accumulation, you're going to have a run, distribution, go back through the bear. You're going to have a little run, distribution, and then back to a bear. And sometimes these bears can last 3 years. So, you got to be real careful when to enter. That's why you don't buy the dip. Because if you buy the dip, after distribution and it drops like $50 on a stock, well, I mean, that thing could be, and you bought it, let's say it dropped $50 in the first month. Well, there could be another 2 years of a drop. So you got to be careful, because once it gets under the 200, people go short and they start making money there. And there's a lot more downward pressure. And it's really hard to fight all that downward pressure. Okay. But eventually what will happen is the market will find a footing, and shorts will cover, and, the price will be, attractive. It'll go back to value, and there's good value there. And the value PE investors will come back in, and Wall Street will start to close their shorts and cover and accumulate, and it'll go back through its new phase. And it kind of just rotates over and over and over in those 4 phases. So trading with the trend and entering technically. So you want to always enter when you're above the 200. And then what I like to do myself is I like to find stuff that's above the 200, and then as it goes up to, say, the yellow line, the 30, I'll move my stop to the 50, and then once it gets above the 20, the pink line, I'll move my stop to the 30, the yellow line, and once it gets to the 9, the green line, I'll move my stop to the 20, and then I'll kind of just ride it there for a little while depending on the stock. And if it's not crazy volatile, I'll just move it onto the 9. But some of these stocks, it's best. Like, for instance, if you were to get rid of the 9, get rid of the 30, get rid of the 20, and you were to buy above the 200 right here, and you were just to basically never sell unless it crossed the 50, well, that's a good technical entry and a technical exit, and in a way that a lot of people do it, including a lot of smart money. So you would buy here, okay, and you never really had to sell. You just stay in it the whole time. And even though it came down, it didn't go through, and it came down, it didn't go through, it came down, it didn't go through, and it went up, and then did this whole thing, and then boom, you sold. And if you did that, technically, you bought this stock at $3.70, and you sold it at $21, okay? So that's 700% by just entering technically here and selling with a rule or condition at the 50, as an example. So you can do that in different ways. You could buy at the 200, sell at the 200. You could buy at the 200, sell at the 50. You could buy it at the 50, sell at the 9. You can depending on where it's at in its market phase. Okay, so entering technically is really important. There's also, entering technically goes much deeper than this. This is just a generalized approach. And when you want to learn a lot more, you will go into my courses, and I'm going to get in super depth with you about this kind of stuff. But let's just look at something of a technical entry. So we could just grab SoFi because I know I have a chart built. So SoFi is super bullish. Okay, now One of the things that you could do if you don't understand indicators and you don't understand volume and you don't even really understand supports and resistances, you can just use the trend like I showed you, trade with the trend and enter technically. So I have these as colored, okay? And when they're blue, they're going up. So I mean, you could essentially just enter when it goes from red to blue and stay in until it turns back to red. So as an example, if you were to buy right here, you bought this at $16.91 and you didn't make a ton of money, but you know, it went to $19.45. So I mean, it's almost $3 and you know, right around $3. And I mean, that's pretty good. So if you had 1,000 shares, you make $3,000 or, right around there. So it's really good. But, entering technically is critical. Other ways that you can enter technically is you have a resistance and you have a base breakout. You have an impulse. This is a little bit more technical. You have an impulse, and then you have what's like a bull flag or a pivot low. And then you look for things like the doji, the volume, the indicators to turn, and then you look for a volume day like this to break past this line, and then you know that you're going to run. So there's a lot of different ways to enter technically and exit technically. The reason I was able to sell right here on this line, I was able to buy in right here and ride this whole thing is because I backed it down to like the minute charts, and I was able to see that we got rejected on that line. And once we were rejected, I think it tried like 2 or 3 times on like the minute, and then it got rejected, and I knew right then to get out. And that's how I get out sometimes within, like the other day I got out within a penny on Chili's, okay? And I bought in on the exact penny of the breakout on Mana, as you know, pretty tight trading. And I do that because I already have this stuff drawn in, and then I'm watching for the breakouts or the rejections on the resistance. So I was able to get out and then, rebuy back in. I made that video, and an hour and a half after the video got released, it went up 12.5%. It wicked all the way up here. But look, we're in an uptrend, okay? There's the 200, it's going up. All your ribbons, that's the 20 through the 50, they're going up. So as long as these ribbons are good, you're in an uptrend. But when they turn red, it's bad. So you want to trade with the trend, and you want to enter and exit technically. Now, another thing I wanted to talk to you about, which is the third tip, is position sizing, okay? It's important to not blow up your account. Blow up your account means that you basically have to go back to work and get another job and then wait a while before you can deposit more money and start over. So you don't want to do that. So in order to not blow up your account, you need to have specific rules and guidelines for yourself. Because even myself, a trained expert in this, I still get FOMO. I still get excited. I'm not a sociopath with no feelings. Like, I get excited too, and I get sad too, So, I have to have rules to keep myself in check. And, the more rules, the better. And it keeps you on track. I have a lot of rules for buying a stock these days. It comes down to like core fundamentals, bullish momentum, institutional support, trading with the trend, entering technically, all kinds of things. But position sizing is important. And if you're kind of new to investing in stocks or crypto, it's best to not go over 10% of your entire invested portfolio amount into one trade. Okay, that would be the maximum for you if you're a novice or beginner. Okay, if you're advanced and expert, you can go all the way to like say 25%. I mean, if you're super savage, you can do like, you can do 2 trades at 50%. You could even do it with leverage, but you got to really know what you're doing. So on the YouTube channel, I don't want you guys to do that. That's not a good idea. Okay, you want to create rules, and you want to position size. You want to be a maximum of 10% on 10 trades or 5% on 20 trades, okay? It's also not recommended, especially in crypto, when you're day trading or scalping, to have too many open trades at a time, because you can miss the rejections and the breakouts, and you can, you just can get distracted. One person calling you at the wrong time can cost you a lot of money. So you want to be hyper focused on 1-2 trades if you're really in the day trading kind of thing, and probably just even 1 is fine. But when it comes to position sizing, what it does is it helps you not blow up your account. And if you add in another layer of protection, which is the stop loss, you basically have 10 trades at 10%, and then you can only lose a maximum of 8%. The reason that you have 8% is because if the market is not right, it will shake you out of 8%. I don't like to lose 8% because I enter technically and I have all these rules. So I typically never lose 8%. But because the way that I do it is I pick it, I go through a whole gamut of things that I do before I choose what I'm going to even have on the watch list to watch. I draw up the chart and then I wait for everything to line up. Maybe it's the stochastic, the vortex, the volume, the RSI. Is it leading? Is it in an uptrend? Is it creating ribbons? All these different things. Does it have sentiment? Does it have institutional support? I got all these things that I look for. And then as soon as it breaks out with volume, like right here, this line, and this broke out with volume, I'm good to enter, say, my 10%, or maybe I do it like 5%, and then I do another 5% over here, something like that to kind of scale in. But I put my stop right below it because this is low. This is a support. So if you buy the breakout and then you put your stop right below, you're actually, you have a support. So even if it comes down, it probably is going to bounce off that support. And then the next time it gets through this one and it goes up, you get to move your stop from here to here. Now you're already in the profit. So psychologically, you can't lose. And you let it go up, and if you see that it's getting rejected, you could just sell, or you could tighten up your stop way up to say over here where the green line is, and that's like the 6 EMA. So it just depends. I mean, if I know it's getting rejected, I'll just pull a trigger and I'll just get out and I'll take all the profits. But on something like this, you don't have to be a trader. You can hold. SoFi is great. I mean, look, it's in a strong uptrend. You don't have to sell these pivots. You don't have to do that with a company like SoFi that's showing so much bullish strength and momentum. I mean, this thing is going to $28.55. Mark my words. I can already tell you what's going to happen. I mean, I've been telling you since this first 3 candles what was going to happen. You guys realize that. The people that have been watching this channel, they know since these first 3 candles, and none of this was on the chart, I told you guys exactly what I was thinking, and every single thing I've said on SoFi is happening. It's doing exactly what I thought it would do. So you don't have to sell and trade this like a swing trader, you just, as long as these ribbons are going up and you're heading up, and look at these impulses, bull flags, impulse, bull. I mean, this is very clean and smooth and a gorgeous thing. And once you basically, once you crossed this line right here, you got a full-blown trend reversal. This was a big one right here, the 1746, and it indicates to everybody that this whole downtrend is over. You're heading up, so that could go on for a long time. So trade with the trend, enter technically, and position size. And when you position size, you're not over invested in any one stock, okay? And you always need to use a stop loss on crypto and stocks, no matter what. And then as far as stop losses go, let's just take a look at a classic stop loss scenario. Now, this is classic swing trading, what I'm going to show you. And there's many ways to set a stop. And in my courses, I show you all the detailed ways. But let me just show you. So let's say you wanted this company called Crocs, and it was red on the ribbons, and you were below the 200. And those are 2 conditions you have to meet. You have to have the blue ribbons, and you got to be above the 200. So you see it goes blue, and then right when it goes above the 200, you buy. You buy right there, and you set your stop where this blue line is, right there. Okay? It goes up, but it doesn't break the stop, so you get to move your stop up. It goes up and doesn't break the last stop, so you get to move your stop up. See, 1, 2, 3. It goes up, and let me enlarge this so you can see how I'm doing that. Let's make it bigger so you guys can kind of see. All right, so you bought in, and once it comes to this bottom wick, and as long as it doesn't break your stop, you can move it up. Comes up to the bottom wick, you can move your stop up. Comes all the way up, it doesn't break this one, so it comes all the way down, you move your stop from here to here. Again, another down day, you move your stop from here to here. You go all the way up, there's another down day, you move your stop from here to here. You go all the way up, it comes down, it didn't break this one, so you get to move your stop from here to here. It goes all the way up. There's another down one. You move your stop from here to here. Okay. And it goes on and on and on through the entire market phase. Again, there's another one, and now you get a double touch. So it's getting interesting. It's kind of flattening off, and it's creating this little top. But these are good. These are good because when you see that, and it kind of does this, and you got the two touches here, and you're kind of wiggling through here. What happens is it's squeezing. It's building momentum. And then what'll happen is at one point there's going to be this big volume day like this, boom, and it's going to break out, and it's going to send it on its next run, its next bull run. So when that happens, right inside the base, you move your stop up and you run, and you just, there's more stops I skipped, but basically you get the idea. There's another stop. There would be another one, and then you come up and you actually would have got stopped right there. But then let's say you wait for the base breakout, which is, let me draw it for you just so you can see. So you actually got stopped for your first time. Okay, so because you had one right there, and it went up, and then it crossed that line, you got stopped, and then you waited for it to come out of this base with volume, which is on this day, and boom, you're back in the trade. Now, when it came here, you made a new stop, and it failed. Okay, so now that tells you, hey, you know what? I've been stopped twice. Let's just wait this sucker out. But look how long that run was. So that run went from $27 for you all the way to $145.80 with classic swing trading stop methodology. Okay, now back to the accumulation enter technically lesson. You basically, since you got stopped here and it created this base, you come down, and what you need to do is you need to break the previous stop point. So boom, right there, it breaks above, and look what happens with volume. Every time, baby, green lights to the beach. I'm your Yoda. You're my Padawan. Pay attention. I'm gonna help you make some money. Boom, there's the base, previous stop, and the volume, and it just happens to line up with earnings too. It's just how it happens. I mean, it's just exactly how it happens. So then, boom, you re-enter technically right here, or actually you would re-enter right here, and then on that volume day, and then you just run it, and then right here, when it breaks above that, you just move your stop, and you just rinse and repeat. So right here, you created a new stop, which I haven't drawn in. So the new stop would be here. Okay, so, okay, just a repeat. So you got stopped out here. Okay, you made a ton of money. You made, what was it, like 400% or something like that? You went from, what was it, 25 to 145. So yeah, it's like, 500%. It's a lot, you almost 5x. So you're out, you skip all this, you come in with the breakout with volume, you set your stop right below, you let it run, another breakout, you can scale in some more money and more shares, and you can put your stop right there, and then you go up, and when it comes down, you make a new stop, and now we're right here. And if it comes down, you get stopped, and if it goes up, the next time it comes down, you put your stop there and let it run, and you just keep riding that. So we got trading with the trend, entering technically. We have don't over position. Okay, so position sizing. We have stop losses. And the next thing that I wanted to give you as a tip is to follow the money. Okay, so everything rotates. Everything rotates. So in 2020, we had, this high growth. Okay, we had the Squares and the PayPals and the, Tesla, all these really cool companies that I like to invest in personally. And, even those will rotate out. And other ones will rotate in, like when the pandemic, a lot of healthcare and biotech and things like that rotated in. And then there was recovery plays and cyclicals, and they just rotate, and as we open up, there's restaurants and food service, okay? And then there's shopping, so there's consumer discretionary and consumer staples, and, they rotate. And now we have infrastructure, so you're going to have sand, gravel, steel, copper, heavy equipment, companies. You're going to have broadband, companies. So it rotates. And right now, and then you're going to have, tapering, and you're going to have rate hikes. So that means that banks, people that lend money, institutions, financials are going to go up. Construction companies are going to go up. Energy is good with inflation, and it's a top sector. It's going to go up. Growth is doing great, right now for quite a few growth ones. So, I mean, that's really out of the 11 sectors, you kind of want to be putting some money in financials, some in construction. So you got the inflation rate hike stuff. You got some money tucked in there. You got some money in energy because it's the number one sector right now. So you got some money in there. You play the infrastructure play. So you got some money in there. You play some growth. You got some money in there. And then if you want to play some of the other ones, just don't go in heavy. And they're probably really down by the 200 or under the 200. So you just put them on a watch list and wait for them to break the 200 so that you can trade with the trend and enter technically. Does that make sense? I hope. So look, I'm hooking you guys up. Do me a favor, make sure you subscribe and you like the video and hit the bell. And again, you're gonna learn so much from me if you get in the Discord. You're gonna be able to talk to me. If you're a Jedi, you're gonna not only get the Wheelhouse Wednesdays where we do the live training and I teach you all kinds of advanced tips and tricks and techniques, but you'll have the one-on-one coaching that's private between you and I, and then you'll have all the courses. The course material is very thorough. You will basically come out of there feeling like you got a PhD in finance from Harvard when you're done. It's pretty cool, especially if you want to learn technical analysis too. Like you learn everything, not there's technical analysis, but this is a big section on technical analysis. Like you will know technical analysis so darn good that you'll be able to read these charts like really, really well. So I highly recommend you click the Discord, you upgrade to Jedi. There's a lot of people in there in the stock and crypto chat. You get so much value for so inexpensive. It's ridiculous. So yeah, I'll move on. But yeah, I just wanted to say that, and the Discord link is in the description. So now that you got all this stuff, you really want to be in those right sectors, okay? And when you're in the right sectors, there's always going to be 1, 2, 3 stocks that are outperforming in the sector, okay? That's called a leading stock. That's why I have this indicator right here. So when the RSI goes above the index, the pink line, it becomes outperforming, okay? That is a leading stock. So if you stay in the right sector where money is rotating and you find a leading stock in that sector, you're trading with the trend and you're position sizing, you're not overdoing it, okay? And then you have that stop loss in there, to protect you. And of course, you entered technically. You already are just making great decisions, and your portfolio is starting to really benefit from it. Now, what makes a stock a leading stock? Well, the answer is pretty darn easy. It really comes down to the fundamentals of the company. There's a lot of things that make fundamentals, from liking the CEO, the ROE, is it being managed properly and efficiently, pre-tax margin, earnings per share growth, annual revenue growth, guidance. So what happens is with the earnings, essentially a company goes through a cycle. It's called the earnings maturation cycle. And what happens is a stock will start in the wrong sector. Okay, so it's under the 200. Let's just call that, I don't know, healthcare for right now. It's just not one of the big sectors right now, but it'll rotate. They all rotate. It always comes back. So everything will get beaten down. It'll go through its phase in the 4 phases. It'll get beaten down. And then what will happen is the value, the PE will be so low that it'll be considered a good value stock. Okay, because the price to earnings ratio is so low. Then what happens is there's a good earnings, like an earnings beat with a surprise or some sort of catalyst on top of that. And what'll happen is it will go through, it'll get some momentum. Some buyers will bring it up, and it'll kind of come above the 200, which is good to enter technically, right? And at this point, usually the EMA of 200 is kind of flat and about to start curving. So it's a good technical entry. It's where accumulation starts from smart money. And after that, the big institutions, what they'll do is they'll hire analysts and they will have them watch the stock, and they will build models around expectations in the future. So when the company reports another earnings, it's going to hopefully beat by a lot again with good guidance and give another surprise over expectations. That is really good. Now you have double momentum, and now the big institutions are really going to accumulate. Your pension funds, your insurance companies, mutual funds, institutions, banks, all these guys are going to come in because you're above the 200. The value is still low. It has momentum. It's showing good fundamentals. It's becoming a leading stock in the right sector that's rotating or about to rotate. They can see it a little early because you want to accumulate early usually. And then, so it went from PE to momentum to earnings surprise to analyst models, and then they have another earnings beat and say they're on their third one. And now what happens is the momentum gets so big that everybody comes in, and it's now the participation phase with institution and retail. And then from there, it'll actually grow at such a fast rate that it actually becomes a growth stock. So it's categorized all the way from a value stock and goes through all those maturation cycles all the way to a growth stock. And then it'll distribute and it'll go back through its downward, and it just, they all rotate. So you want to rotate with the money, you want to rotate with the sector, and you want to find the leading stock in the sector. You want to enter technically, you want to trade with the trend, you want to position size, you want to set stop losses, and you want to make sure that those earnings are really, really good. If the earnings only meet expectations, expect the stock to drop because everything is priced in. Just like Charles Dow said in the Dow theory, everything trades, everything's priced in at a discount. So if the analyst estimate on the street says it's going to be worth 30 cents a share and it comes in at 30 cents a share, there's going to be a big drop. It's only going to go up if there's a surprise, and it's a big surprise. And if there's a big surprise, it's going to go up a lot. And you see that all the time in after hours and pre-market. So the last thing I want to tell you, last tip, and it pertains to all of it, is to add in institutional support. So if you're in the right sector with the right leading stock and you enter technically and you're above all those EMAs, and then you notice that all the institutions has a large institutional holding, well, that means that you have another huge layer of protection. Okay, not only are you protected by the 9 and the 20 and the 30 and the 50 and the 200 and all these other supports and resistances that are drawn on the chart, and you got a company with momentum, and analysts are upgrading and revising, but you have institutions, and the institutions are going to protect their bet. They're not going to put in millions or billions of dollars into a company and then just let it fall apart. And usually when one premium institution comes in, there will be a second, a third, and 4, 5, 6 of them, and then there will be a whole bunch of middle range ones. And that's all that support is really good for us because if it falls, it's not going to fall to the ground. So it's good to invest in bigger companies that have really good earnings. And if you're looking to, if you're looking to invest in a company, but it's out of favor in the sector, that's okay. Don't have your money in there. Have it on the watch list and let it come up above the 200. And as soon as it does, make sure there's some institutional support and some catalysts and the earnings are going good. Set your stops, position size, trade with the trend, and boom. Now you have that in your portfolio, and you might be trimming out something that you just made a lot of money on that is coming out of favor on a rotation. So look, those are some really, really solid tips for everybody, and I really hope this helps. And again, the Discord link is down below. I've been a professional trader and investor for a very long time. I've been a CIO. I've been a CEO of 3 global companies. I have quite a resume of success, and I did this video because I wanted to help out. And if you made it all the way to the end, then I know that you are serious about making money. And that is the kind of people I want in my Discord. So saying that, welcome to the wheelhouse.